Hi everyone, welcome back to Saheb Academy. Today in this fifth video of bonus and right issue chapter, we are going to understand the whole concept of right issue, the provisions of the Companies Act, the accounting treatment. Yeah, it's really simple, don't worry. And in the previous videos, what we have done, in the previous 4 videos of this chapter, we have discussed entirely about bonus and solved problems on bonus, right? So bonus part is over. We are moving on to the second part of this chapter, that is right issue. Okay, so let's start and let's understand everything. Now see, here we have the concept of right issue. Let's understand by reading these two paras and then we'll take an example. So see here, right issue is an issue of rights to existing shareholders that entitles them to buy additional shares directly from the company in proportion to their existing holdings within a fixed time period. Yes, that's what a right issue is. Okay, and then in a rights offering, in a rights issue, the subscription price, the offer price, or you can say the right price at which each share may be purchased is generally at a discount to the current market price. The subscription price, the right price, or the offer price will be lower than the current market price. Okay, that's what usually happens always. Fine. So that is what basically the concept of right issue is. So did you understand anything? Let's discuss. Okay, I know you haven't got 100%. Let's discuss. Don't worry, it's really simple. Let's just say there is this company ABC Limited and this company wants to go for right issue. So what this company will do? This company will send a letter to each shareholder, each and every shareholder, explaining all the terms and conditions and everything regarding that right issue. Okay, so basically what will happen is the existing shareholders will be given what? A power, a right, an option, not an obligation, option, an option to do what? What they can do with that option, with that right? With that right, they can buy additional shares. This is not like bonus, okay? In bonus, the existing shareholder used to get shares free of cost. Here it's not like that. With the right, with that haq, in Hindi we say haq, right? With that right, the shareholders, existing shareholders only, they will be able to buy additional shares directly from the company, not from the market, directly from the company in proportion to their existing holdings. What does this mean? In proportion to existing holdings. In bonus also this used to be there, in proportion. Proportion means ratio over here. Okay, ratio. If you have 10 shares, then let's just say ratio is 1:10. So if you have 10 shares, then a right will be given to you to buy how many shares? 1 share. 1:10 means if you have 10 shares, you will be able to buy 1 share. 1:5. If you have 5 shares, you will be able to buy 1 share. 1:2. If you have 2 shares, you will be able to buy 1 share. Like that, buy. You will not get free of cost. No. This is not bonus. Here there is cash flow involved. Okay, it's not like bonus. In bonus there was no cash flow. Here there is cash flow. The company will receive the money because company is in need of funds. That is why the company is going for right issue. Okay, here what is happening basically, existing shareholders are getting first preference. Okay, that's what basically happens in right issue. So that is what a proportion is, 1:2, 1:5, 1:3. All right. So a ratio will be decided by the company, and in that letter which will be sent to the shareholder, each and every shareholder, in that it will be mentioned 1 for every 3, 1 for every 2. Okay, that thing will be mentioned over there within a fixed time period. Yes, there will be a fixed time period within which all this should happen. Fine, we'll discuss regarding that more while discussing the section 62 of the Companies Act. Fine, and then see here, in a rights offering, the subscription price at which each share may be purchased is generally at a discount. Yes, what will happen is, see, why the existing shareholders will buy the shares from the company? Why? Only if the price is lower than the market price. For example, if in the market price the share price is how much, let's just say 50 rupees, then the subscription price, the right price, the offer price will be at 40, 10 rupees less, like that. Okay, so it will be attractive to the existing shareholders to buy, isn't it? For example, let's just say subscription price is 60 and market price is 50. Will you buy from the company? Of course not. You will say, I'm in market, in open market, I'm getting 50. So I will buy from the market if I want the shares of this company, isn't it? So that is why in rights offering, the subscription price will be lower than the current market price. Is that clear? Fine. So this is what basically a right issue is. Now the main question is why the company is going to existing shareholders. Yeah, you did not understand the logic of this, right? Yes, you understood how the process will happen. Yeah, what is right issue, you understood. 50%, 60% you understood. But now what is the logic? Why the company is going to existing shareholders? Why the company is giving right to existing shareholders? Why not other shareholders? Yeah, that thought is coming into your mind, isn't it? So because of that, let's just understand now section 62. Okay, let's take an example to understand section 62 of the Companies Act 2013. It's really simple. Let's say there is this company called as ABC Limited, and this company wants to do a big project and it costs, let's just say, 500 crores. So now what the company can do? Company wants funds. So what the company can do? Company can get a loan, issue debentures, yeah, debt financing, or the company has more primary option, that is raising equity finance, yeah, issuing equity shares, fresh issue of equity shares. So can a company directly go for fresh issue of equity shares? Can a company directly go for fresh issue of equity shares? No, of course not. Because section 62 of the Companies Act 2013 will come in between. Yeah. Why section 62 of the Companies Act 2013 will come in between? If the company wants to get funds, if company wants to, issue equity shares, then company should be able to do that, isn't it? That's what you're thinking, but no. There is a reason for that. Why the Companies Act, yeah, section 62 is coming in between. Let's understand. If company directly issues fresh issue of equity shares to outsiders, then what will happen? The existing shareholders, yeah, their shareholding of existing shareholders will be diluted. The ownership of existing shareholders will be reduced. This is what will happen. Let's take another example within this to understand the dilution of shareholding. See here, what is dilution of shareholding? It is the decrease in existing shareholders' ownership percentage of a company as a result of the company issuing new equity. When company issues new equity shares to outsiders, then what happens? Existing shareholders' ownership, yeah, their governance as well as their voting power goes down. Okay, that's what happens. Let's take an example. Let's just say there is this company which has 10,000 shares at 10 rupees each. Okay, and then company go for further public offer, further issue of 5 lakh shares. Of how many? 5 lakh shares. So after this issue, how many total shares are there in company? How many total shares are there? 15 lakh shares at 10 each. Yeah. Now this 5 lakh shares have gone to outsiders, not to existing shareholders, to outsiders. Okay, so now what will happen? Let's take a simple example of an existing shareholder, Mr. Akash. Okay, Mr. Akash, who was there from the beginning only. Okay, so Mr. Akash. So before further issue, Mr. Akash had how many shares? 10,000 shares. Okay, he had 10,000 shares. After the further issue also, he has 10,000 shares. So now what is happening? Understand. Total shares in the company were 10 lakh and then it became 15 lakh. But Mr. Akash has the same number of shares, 10,000 shares. So obviously, the percentage of ownership of Akash will go down. See here, Akash holding, let me just show you. What is the Akash holding before the further issue? 10,000 number of shares owned by Akash divided by the total number of shares outstanding in the company, that is 10 lakh. So that is 0.01, which means 1%. Into 100 means 1%. Okay, it is 1%. See here, it is 1%. 10,000 divided by 10 lakh into 100, 1%. But after the further issue, denominator increased. Increased. 10,000 divided by 15 lakh. So if that is the case, 10,000 divided by 15 lakh, then the ratio, the percentage, the control percentage of Akash has come down. How much it is? Into 100, it is how much? 0.666667. Yes, so 0.67%. Yeah, 0.67%. Yeah, so his shareholding has been diluted, isn't it? So this is what will happen. For example, let's just say you have an ownership in a company of 51%. You are controlling the company, and then let's just say what the board of directors do. After 10 days or something, the board of directors decided to issue fresh issue of equity shares to outsiders. Then what will happen? You were the owner, 51%, you had the control of the company, but just after 10 days or something, what will happen? The owner will be someone else. You will lose the ownership because new shares will come into the picture, and your percentage will go down. It will be diluted. You see, this is what will happen. This is a danger. Yeah, this is a danger. So that is why the Companies Act, yeah, section 62 of the Companies Act comes in between whenever a company is going for a fresh issue of equity shares. There are some conditions that the company has to follow. Okay. Now, it's not that company cannot do fresh issue of equity shares to outsiders. No, it's not like that. Company can do that, but there is a condition. The condition is that existing shareholders should give the permission. Existing shareholders should give the permission. Okay, a special resolution should be passed, and then only company can issue shares to outsiders. Okay, yes, that's the thing. But now regarding right issue, let's discuss section 62 of the Companies Act. See here, if a company wants to do further issue of shares, ask the existing shareholders first. Yeah, ask the existing shareholders first means, see, the first thing is passing a special resolution and issuing the shares to outsiders. That option is there here only. The second option is give the existing shareholders a right. Yeah, see here, ask existing shareholders first by giving them a right. Right to what? Right to subscribe in proportion to their existing holding. Yeah, in proportion to their existing holding. Basically, it means doing right issue. This is where right issue was born. This is where right issue was born. What happens in right issue? In right issue, first preference is given to existing shareholders. Okay, so three options will be available to the existing shareholder. Now, three options will be available. The first option is the shareholder can subscribe, buy the shares fully or partially. For example, let's just say for example, a shareholder has 10 shares. A shareholder has 10 shares, and the ratio is, let's just say, 1:2. Okay, 1:2. So 10 shares are existing into 1 divided by 2. So how many shares he can subscribe? He can subscribe 5. So he can sell the right to subscribe. Yeah, he can buy 2 shares, and the right to subscribe to 3 shares, he can sell that, and that's called renunciation of right. Okay, so he can subscribe fully or partially. Now understand, this is not bonus issue. Here the shareholder will have to pay. Okay, will have to pay, subscribe, but that will be at a discount price. You saw, now see here, the subscription price will be at a discount to the current market price. Okay, yes, so this can happen fully or partially. And then there is another option that is called as the renunciation of right, renouncing the right. What it means? It means selling the right to any other person. Now understand, you are not selling the share over here, you are selling the right. You got a piece of paper which has a power, an option to buy the shares, additional shares directly from the company. Yeah, so this right is valuable. This right is valuable. Why is it valuable? Tell me, why is it valuable? It is valuable because with that right, you can purchase the shares at a discount, yeah, to the current market price. That is why that right, that piece of paper has a value. Okay, so you can sell that. There is a monetization in that. Okay, so you can sell the right and get the benefit, yeah, get the money. Okay, but this renunciation should be permitted in articles of association. Yeah, if the AOA, if articles of association is silent, then it will be assumed that renunciation is allowed and you can sell the right. Okay, and then there is third option. What is this third option? Rejecting the right. Yeah, what does it mean? It means that you are not subscribing, you are not selling, you are just doing nothing. You are just sitting and waiting till the time expires. See here, do nothing shall be deemed to have been declined after the expiry of the time limit. After the time limit expires, then what will happen? if the right is expired, then in the company, from the company's point of view, this is from shareholders' point of view, subscribe, renounce, reject, yeah. But from the company's point of view, what will happen? If you reject or do nothing, then what will happen? The right will be expired, but there will be some unsubscribed shares. There will be unsubscribed shares from the company's point of view. So those shares, what will be done of those shares? See here, then BOD, Board of Directors, will dispose of such shares in a manner which is not disadvantageous to the shareholders or the company. Okay, that is what the Board of Directors will do. They will do whatever which is in best interest of the shareholders and the company. Basically, what the Board of Directors will do is either they will cancel those shares. Sometimes what will happen, issuing the shares to outsider is more costly. If less number of shares are left, then it is more costly than the benefit they will get out of that, the money which they will receive. The cost will be high. If that is the case, if the cost is high and the benefit is less, then they will cancel the shares. But if it is possible, if there is a benefit, then they will issue those shares to the outsiders. Yeah, in the right issue, everything was done for insiders. At the end, if there are unsubscribed shares, then they will issue that to the outsiders. Is that clear? Subscribe, fully or partially, renounce, sell the right. Now this fully or partially means what? Fully means fully subscribing. Yeah, I told you now, if a shareholder has 10 shares and the ratio is 1:2, then he is getting a right to subscribe how many shares? 5 shares. So he can subscribe 3 shares and sell the right to subscribe another 2 shares to some other person. Okay, yes, that's what partially means. Okay, partially he can subscribe, partially he can renounce, and partially he can reject. Okay, all the combination he can do, partially means. Now renunciation is what? Selling the right. The same thing, selling the right. Okay, renunciation. Now understand, when you are selling the right, now you will sell the right at its value of right, and you should know how to calculate the value of right. We'll discuss that, don't worry. And you can sell the right to any person. Okay, he or she can be an existing shareholder or other person also, third party also, it doesn't matter. Okay, fine. So these are the 3 options you have: subscribe, renounce, reject. And then see here, all this process has to be done. Yeah, all this right issue, this whole thing has to be done within the time limit. Yeah, we discussed something about time limit over here, right? Time limit expires. So what is that time limit? Here also we discussed fixed time period. What is that time limit? That time limit is, according to the Companies Act, section 62, it is 15 to 30 days. The Companies Act says minimum 15 days, maximum 30 days. A company has to decide on its own what will be the time limit. They can say 15 days, they can take 30 days, but they cannot take 7 days, 10 days, 35 days, 45 days. No, it has to be within this limit, 15 to 30. It could be 17, 25, 23. Okay, so this is the time limit, which is also known as the offer period. Okay, and this date will start from the that letter. Okay, from that letter. Is that clear? In that letter it will be mentioned, and that letter will be posted 3 days before the time limit. Okay, fine. So this was the section 62 of the Companies Act, and you understood why is it like this, because of the dilution of the shareholding. Yeah, it's very dangerous for the existing shareholder. That is why section 62 is there. Okay, if a company wants to do further issue of shares, then the company has to ask the existing shareholders first, either pass a special resolution and then go for fresh issue of equity shares to outsiders, or go for a right issue. Yeah, in right issue what happens? The existing shareholders are given 3 options, either to subscribe fully or partially. Partially means the combination of all these options. Okay, and then the second option is renunciation, that is selling the right to any other person, and it should be allowed in articles of association. And then the third option is the stupid option, which is rejecting the right. Okay, if you don't want the right, sell it, don't reject it. Okay, so this is the stupid thing, and that's what. And then here there is offer time, the offer period, that is 15 to 30 days. Fine. Yes, so you understood this, right? So the same thing I have written over here also. Okay, existing shareholders subscribe at discounted price, that means buy the shares fully or partially. And renunciation, see, shareholder surrenders the right to buy the shares and transfers such right to any other person It doesn't have to be like existing shareholders or something. No. Sell the right means to any other person, okay. This renunciation of right is valuable. Why it is valuable? Because with that right, any person can buy the shares at a discounted price. That discount benefit is there now. So because of that discount benefit, that right has a value, and that value you have to calculate, and at that value you can sell the right. Okay, this renunciation of right is valuable, so the right can be sold at a price called as value of right. Okay, we'll see now how to calculate the value of right. And then third option is reject the right, do nothing, shall be deemed to have been declined after 15 to 30 days from the date of offer. Date of offer means the date which will be mentioned in that offer letter, okay, which will be received by each of the shareholder, each and every of the shareholders in the beginning of the right issue. Fine. So this is the entire concept of right issue. Now let's move on to the concept of value of right. How do we calculate the value of right? Let's do that. Now here we have the formula of value of right. But before going into that, let me just explain to you once again what is value of right. I know some of you are still confused, little bit confused about that. Not everyone, some. So listen properly. I told you that existing shareholders will get a right, and they will have three options: subscribe, renounce, reject. Under renunciation, what happens? Existing shareholders are selling the right to any other person. So at what price they will sell? That is the $1 million question. At what price they will sell? What is the price? That price is value of right. Maximum price at which the right can be sold is value of right. Okay, this renunciation of right is valuable. Why is it valuable? Because a discount element is there. Yeah, because of that it is valuable. So the right can be sold at a price called as value of right. This is maximum price. Okay, you can sell at within that also. Fine. So that is what a value of right is. So how can we calculate? There are many formulas to do that. Okay, in CA final you will see there are many formulas to calculate value of right. But right now in CA Inter, in your module, this formula is given. Okay, value of right is equal to cum right price, or you can say cum right value minus x right value of a share. Okay, value of right is equal to cum right price of a share minus x right price of a share. Now you will say, sir, what is this cum right price and x right price? It's really simple. Cum right price means market price of the share before the right issue, and x right price means market price of the share after the right issue. So basically, what is the difference before and after? The difference is that here in cum right price, the right benefit is there, and in x right price, right benefit is not there. It is excluding the right, and this is cumulative of right. Okay, but basically if you just want to understand, before, after, that's it, that's all it is. Okay, now mostly in the question what happens, this cum right price will be given to you. In the question, cum right price will be given to you. What is the market price before right issue, and then the offer price will also be given. Okay, for example, 50 is the market price, and then right issue has been announced, 1:10 is the ratio, and then the offer price, the right price is, let's just say, 30 rupees. But this x right price will not be given to you in the question. What is the market price after right issue? This is kind of a future thing. Yeah, if today right issue is announced, let's just say after 2 days you are doing accounting, then you will not have this. Yeah, because this is a future thing now. So you will have to do some estimation, and you have to calculate this. You have to do some calculation. Theoretical x right price, we call it TERP. We also say TERP in short form. Okay, so that is what this you have to calculate. So you have to understand the formula for this also. It's really simple. The formula for x right price is what? Just weighted average price. Okay, so let's see that. Okay, let's see the formula of x right price. See here, it looks kind of a messy formula, a big formula, but really it's really simple. See here, what are we doing over here? X right price, which is also known as weighted average price, because we are taking a weighted average over here, also known as TERP, theoretical x right price. Yes, it's a theoretical x right price. Okay, it's just an estimation, not actual price. Okay, this is actual price, cum right price, but x right price is just an estimation. Fine. So see here, what is happening in this formula? Let me just broadly explain this to you. This is the market capitalization before the right issue. Market capitalization before the right issue. And then you will add the cash flow generated from right issue. Cash flow generated from right issue. And then you will divide total number of shares after the right issue. That's the broad formula. If you go in detail, how will you calculate market capitalization before the right issue? Simple. Number of shares before right issue into cum right price. Into cum right price, which means market price before the right issue. Before number of shares, before price. Okay, that's how you will get market capitalization before the right issue. Simple, entirely before thing, this section. This, okay. And then cash flow generated from right issue. This is from the company's point of view, yeah. This X right price, yeah. So number of right shares into right issue price. Cash flow generated from right issue. That's a broad category. Cash flow generated from right issue. So how will you calculate that? Number of right shares, yeah, number of right shares into right issue price. Yeah, they will announce now how many right shares and how many right issue price. It will be given to you in the question. So you can just multiply that. You will get the cash flow generated from right issue. And then denominator is number of shares. Total number of shares after the right issue. So how will you get that? Really simple. How many shares were there before the right issue and how many right shares are issued? Just add up both of them. Yeah, you will get total number of shares after the right issue. Just divide that. Yeah, that is the explanation of this formula. So basically what's happening over here? Tell me. If you look carefully, what is happening over here? It is just total net assets divided by total number of shares. That is what basically happening over here. But since this is weighted average, so everything has to be done separately. Okay, this is the right thing. This is market capitalization before the right issue. Okay, now this looks really complicated, but believe me, when we will do the sum, we will not follow this formula. We will even simplify this. We will simplify this so much. See here, let's take an example. Okay, forget about this. It's really simple. Let's take an example. See the example over here. The company has 1 lakh equity shares with market value of 25 per share. Now this market value, what is this? Tell me, what is this? This is cum right price. Yeah, this is cum right price, market value of rupees 25 per share. The company made the right issue of 1:10. If a shareholder has 10 shares, then he will be given a right, he or she will be given a right to purchase one additional share. That is what 1:10 means. Okay, fine. 1:10 at 14 per share, rupees 14 per share. What is this rupees 14? This is the right issue price. Rupees 14 means right issue price. Okay, right issue price. Calculate the value of right. What is the formula of value of right? Cum right price minus X right price. Cum right price minus X right price. Do we have X right price in this question? No. In this example, we have only cum right price. We don't have X right price. Yeah, we don't have X right price. We only have cum right price. Yeah, yes. So first we have to calculate X right price. How will you calculate? If we use this formula, then how you have to do this? Let's use that formula first. Okay, number of shares before the right issue 1 lakh into cum right price 25. So this will become how much? This will become how much? 1 lakh into 25. It will become 25 lakh. You all know. Yeah, 25 lakh plus cash flow generated from right issue. So what happens over here? Number of right shares. How many right shares will be there? Here you have got 25 lakh. Yeah. So how many right shares will be there? It's 1:10. The ratio is 1:10. So existing shares are 1 lakh into 1 divided by 10. So 10,000 right shares. 10,000 right shares now. 1:10 means. So number of right shares are 10,000 into right issue price. That is 14. Yeah. So 10,000 right shares into 14. 14 is what? Right issue price. Right issue price. So if you multiply, that is equal to 1 lakh 40. So 1 lakh 40 and here 25 lakh we have. Divide by number of shares before right issue plus number of right shares. Yeah. So what were the number of shares before right issue? 1 lakh. What were the number of right shares? Number of right shares were 1:10, 10,000. Yeah. So 1 lakh 10,000. So 25 lakh market capitalization before the right issue. Yeah. This part plus this part is how much? How much was this part? I forgot. It was 1 lakh 40,000. Yes. 1 lakh 40,000. 1 lakh 40,000. So 26 lakh 40,000 divided by how much? How much? Here 1 lakh 10,000. 1 lakh plus right shares. 1:10, 10,000. Yeah. So 1 lakh 10,000 shares total number of shares after the right issue. So that will give you 24. 24 is your TERP. 24 is your theoretical ex-right price. In a perfect market, what will be the future market price after the right issue? 24 rupees. Okay, weighted average price, ex-right price. Okay, so many names are there. Fine. So see, okay, that's the answer. See here, 24. But you see this calculation. What is this calculation? You'll be shocked. It's a really simple calculation based upon the ratio. With just the ratio, you can do this calculation. Okay, so see here, how will you do this simple calculation? The same answer will come. How much did we get? 24 with this big formula, right? Full expanded formula. Now let's see how we can do this calculation with this small formula. See here, the same thing will be there. It's just that you will replace number of shares, number of right shares, here also number of right shares with the ratio. Okay, with the ratio you will replace. Come right price and right issue price will be there, same. Okay, let's see how this will happen. See here, X right price is equal to, okay, how did I take 10 over here? That is the number of shares before right issue. The ratio is 1:10 now. If you have 10 shares, then only you will get right to subscribe 1 share. Yeah, 10 share existing now. So that is the 10 shares before right issue, 10 shares into come right price. That's the same, 25 only. There also we took 25, yeah, in the big calculation. Plus 1 is what? Number of right shares. According to the ratio, 1:10 now, 1:10. Ratio is 1:10 now, so 1 into right issue price, offer price, it is 14. Yeah, right issue price, offer price is 14, subscription price. So 1 into 14 divide by the total number of shares after the right issue, divide by the total number of shares. But according to the ratio, how it will be? 1 and 10 are there, just add it up. Yeah, 1 right and the 10 is existing shares. So 1 plus 10, 11. Okay, so see, 10 into 25 plus 1 into 14, that will give me 264. Divide by 11, that's equal to 24 rupees. The same thing, X right price is 24. Okay, it's 24. Did you understand? Really simple and straightforward. What did I do over here? I just used the ratio. For example, the ratio was 1:5. How I would have changed this? If it was 1:5, here 5 would come, here 1 would come, and then divide by 6. 1 plus 5 is 6. If the ratio was 1:2, then here 2, here 1, and here 3 will come. 1 plus 2 now 3, like that. Like that you have to take this formula. A simple formula to calculate X right price, also known as the weighted average price, TERP. Okay, fine. And then you can calculate the value of right. How will you calculate the value of right? Same formula, come right price minus X right price. Market price before the right issue, market price after the right issue. We calculated the X right price 24, so just take that 24, and this come right price is 25, which is given in the question 25. So 25 minus 24 is what? Value of right per share held, 1 rupees. This value of right is per share, understand? Okay, this formula now, which is there in your inter syllabus, this is value of right per share held. In CA final you will see many formulas will be there. Okay, come right price minus right offer price will be there. That will give you the value of right in a whole thing. Okay, whole value of right. But right now this formula is value of right per share held, per share held. If you want to find the total value of right, the whole value of right, then you have to multiply. You have to multiply. In this case you have to multiply with 10. See here, understand? Come right price minus X right price, 25 minus 24, you got 1. What is this? This is value of right per share held. If you have 10 shares, then only you will be able to, get a right to subscribe 1 share, isn't it? So this 1 rupee is the value of right per share held. That means 10. Yeah, isn't it? So that is why this 1 rupee you have to multiply with 10. So 10 rupee will be the whole value of right. 10 rupee will be whole value of right. So if you want to sell, if let's just say you got you had, let's just say 20 shares, for example, you had 20 shares. Okay, you had 20 shares. So how many right will you get from the company if you have 20 shares? 20 is to 20 into 1 divided by 10. So you will get 2 rights. Yeah, you will get 2 rights now, isn't it? You have 20 shares, you will get a right to subscribe 2 shares, isn't it? So if you sell that, at what price you will sell? You will sell at 20, isn't it? See, value of right per share held. How many share did you have? You had 20 share. So you are selling everything now. So 20 into 1, yeah, that's equal to 20. So this is the maximum price at which you will sell your right. Okay, let's take another example. You will be more clear with this. Okay, let's take another example. Now let's see this another example of value of right with logical understanding properly. Okay, not just the formula and mechanics. Let's understand the logical part. Okay, so let's say there is this company having 10,000 shares, and then the market price of those shares before the right issue is rupees 40. Okay, so you all know this is come right price, come right value of a share, isn't it? Yes. And then the company is going for right issue, and the ratio, the proportion is 1:4, 1 share for every 4 shares. If you have 4 shares in the company, existing 4 shares, then only you will get a single right to purchase 1 additional share. That is the meaning of this. And then the price at which right issue is happening, the offer price, subscription price, or right issue price, whatever you want, you can call it, that is rupees 30, which you all know will be at a discount to the current market price, rupees 30. And then we have to calculate now what is the value of right. Yeah, value of right. So first understand, logically, what is value of right. Logically, value of right means whatever the benefit is there in right now, that is the value of right. Okay, how do we use this value of right? To sell the right. Yeah, maximum at that price we sell the right. The shareholders sell the right. Yeah, but logically, what is value of right? The benefit which is there in that right, that will be the value of right. What benefit is there in value of right? You all know, with the right, what you can do? With the right, you can purchase the shares directly from the company at a discount to the current market price. Yeah, so this discount element is there in the right. That is the benefit. That discount element is the benefit. Okay, so tell me, what is the discount element over here? Do you think this is the discount element? Current market price is rupees 40 and the offer price is rupees 30. Do you think rupees 10 is the discount? Yeah, no, rupees 10 is not the discount. It feels like that. Yeah, rupees 40 and here rupees 30, so 10 rupees discount. If I purchase the share directly from the company at rupees 30, then I will be able to sell later that share in the market for rupees 40 and make 10 rupees profit. Yeah, you are thinking like that, but you cannot do that. Why? Understand properly. What will happen in the market is, see here, right issue will be announced. At that date, let's just say the market price is rupees 40. Yeah, so this 40 rupees is what? Come right price. Yeah, market price before the right issue, isn't it? Right issue is not completed. Yeah, in this rupees 40 there is a right element. Okay, it's cumulative of right, so it is come right price. And then what will happen? Slowly, as the time passes, you all know 15 to 30 days limit is there. Yeah, to entire right process to complete. So in that 15 to 30 days, what will happen is the market price of the shares, market price of the share of this company will keep on falling. Slowly it will keep on falling day by day, and till the allotment date, what will happen? Market price will fall by a considerable amount. Let's just say, for example, 38. It falls to 38. Okay, so it will fall. Now at this date, and at which the the shares will be allotted, the offer price, the subscription price, or the right price is rupees 30. Yeah, now here you will see the discount element properly, and this discount element, the difference is value of right, the whole value of right, not per share and all, the whole value of right. Okay, offer price minus the market price. Okay, also known as the X right price. This, which market price is this? This is X right market price. X right means excluding of right. Yeah, record date will be passed, and no more you will be able to get the right. Fine. So at that date, the market price will be X right price. Is that clear? So the difference between this 38 and this 30, 8 rupees difference is there. That is the discount element. On that date, if you get a share by purchasing it for 30 rupees, then only you can sell it for 38, not 40, because the price has fallen. So this is the true discount element, and that is the value of right. What is the value of right over here? The whole value of right. Okay, not the per share value, not this calculation I'm saying, not this calculation, not come right price into minus X right price. No, the whole, not per share I'm talking about. I'm talking about the whole value of right. Whole value of right is the discount element. 30 minus 38, Yeah, 38 minus 30, that is 8 rupees. 8 rupees will be the whole value of right. At that price you can sell your whole right. At that price you can sell your whole right in this case. Okay, that's the thing. But now let's do our calculation. What is our calculation? See here, really simple. X right price. What do? First, what do we take? We take before the right issue. Yeah, before the right issue, existing share. In the ratio format we are doing this. Okay, simplified way. So what is the ratio? 1:4. So first you will take 4 into come right price. What is the come right price? Rupees 40. Yeah, 4 into 40 plus, and then you will take right. You know, the right cash flow generated from the right issue. So that is 1:30. 30 is the offer price. Yeah, offer price, right price, and 1 is the right share. 1 is the right share, isn't it? That same formula only, simplified way. Yeah, come right price, right issue price, number of shares before right issue, and number of right shares. But we are not taking the total number of shares over here. We are taking what? Just the ratio. 1:4 na. 1 is the right and 4 is the existing. So existing 4 and 1 is the right. Okay, and divide by what? 4 plus 1, that is 5. So if you do this calculation, what do you get? Let's see this once again. 4 into 40 plus 1 into 30, that's equal to 190. Divide by 5. How did we get 5? 4 plus 1. 1:4 is the ratio. So 1 plus 4, yeah, 4 plus 1, that's equal to 5. Divide by that, we get 38. Now this 38 is what? This 38 is X right price or weighted average price, TERP. Yeah, this price, the future price which will be there, 38. Okay, this is just an estimation. It's not real actually. Again, a perfect market, this situation will happen. Okay, it's like that. This is happening in a perfect market because this is a theoretical X right price. Okay, so 38 is what? This is the X right price. So if you take the difference between this 38 and the right price 30, 8 rupees, 8 rupees will be the value of right, the whole value of right. But now in our module, how it is there, this formula is there. First we calculate value of right per share held. Yeah, this formula. So if you go according to this formula, then see value of right. What is this? This is per share held formula. Okay, per share held formula. Come right price minus X right price. Let me put that in bracket. Come right price minus X right price. What is come right price? Come right price is 40. So 40 minus 38 X right price, the same thing which we did over there now. The same thing, see here. Come right price minus X right price. 25 minus 24 we did. Value of right per share held, the same thing. Okay, so 40 minus 38. Yeah, 40 minus 38, that is equal to 2 rupees. This is value of right per share held. This is value of right per share held. Fine. Okay, now understand logically. How will you use this value? If you are a shareholder of this company, how will you use this value? What does this mean? How does it help you? See, it's really simple. Let's just say this is you. Okay, you have 12 shares of this company. If you have 12 shares of this company, then company will give you 3 right, isn't it? The ratio is 1:4 now. See here, simple calculation. If you have 12 existing shares and the ratio, right ratio in the company is 1:4, so into 1 divided by 4, so you will be given 3 rights to purchase 3 additional shares of the company, isn't it? But now you decided, I want to sell my rights. Yeah, I don't have money to subscribe. Yeah, I don't have money right now. I'm in short of funds, so I just want to sell the right and get the money. Okay, I just want to get whatever monetization is available in that right. So let's calculate value of right over here. So in this case, in this personal case of this shareholder, what is the value of right for him? Value of right, it's really simple. How many rights he has? He has 3 rights. 3 rights means how many shares? 3 rights means how many existing shares? 3 rights means existing 12 shares. 3 rights means existing 12 shares. Right? So 12 shares. Into what? Into rupees 2. Because rupees 2 is the value of right per share held. He held how many shares? 12 shares. So 12 shares, value of right per shares held na, so into 2. Okay, 12 shares are the shares held into rupees 2. That will give him how much? 24. 24 is what? 24 is the money, maximum money he can get by selling of his 3 rights. Okay, 3 rights, not 3 right, 3 rights. Okay, now let me just show you another way of doing this. Okay, see, what you could also do was, see here, X right price is 38. You can take X right price 38 minus, yeah, you have to do the calculation, this calculation, you will get 38, and then minus right price. not this formula, different formula I'm saying. See here, x right price minus right price. Okay, x right price minus offer price, right price, that is 30, that will give you 8 rupees. This 8 rupees was the discount element, and that will be the whole value of the right. That will be the whole value of the right. How much? 8 rupees. Now how this 8 rupees this guy can use, how you can use this? See, how many rights he got? 3 rights. So 3 rights he want to sell, and the value of the whole right is 8. Just now we calculated, yeah, just the difference between these two was the whole value of right. So if we multiply, then 24. Both the ways you will get the same answer. Both the ways, when you use that, you will get the same answer, 24 only. See, it's just that this 2 rupees is value of right per share held, and there is another formula which is value of right is equal to x right price minus offer price, right price. If you follow that formula, then you will get the whole value of right. Okay, value of right, we also say per share applied. Okay, it's just the whole value of right. Okay, so that's what I did. I got 8, so 3 rights into 8, 24. Is that clear? If you have more doubts on this, then don't worry, just message me on Instagram or comment down below. I will explain to you. Okay, it's really simple, there's nothing over here. But in your syllabus right now, in C&A syllabus, you just have to follow this formula only. Okay, and just write a small comment, just multiplying the shares, existing shares. Okay, see how 2 into 12, yeah, 24. Is that clear? That's how you have to do this. Now let's move on to the accounting treatment of right issue, which is really simple, same as fresh issue. Let's just have a glance on that. It's really simple. You understood this now? This is the most important part. Okay, fine. So what will you follow? You will follow this only. Okay, this formula only. Come right price minus x right price. Okay, this formula only, this calculation only you will do always. Fine. And for this expanded, don't follow this, just follow this simple one only. All right. Okay, then let's move on to the accounting treatment. Now here we have the accounting treatment of right issue. It's really simple. It's same as fresh issue of equity shares. Okay, 2 alternatives can be there. Okay, 2 situations can be there. So let's take 2 examples of both the situations. Okay, so see here, the example 1, a company having 70,000 shares of rupees 10 each as its issued share capital, having market price of rupees 21. Okay, rupees 21, issues right shares in the ratio of 1:10 at an issue price of rupees 10, pass journal entry for issue of right shares. So what's happening over here? A company has existing 70,000 shares, and then they have given you the market price of rupees 21, which is not helpful for you right now. Okay, issues right shares in the ratio of 1:10. 1:10 is the ratio. So first you have to calculate how many right shares are issued, because you're doing accounting of that. So into 1:10 means 1 divided by 10. 1 divided by 10, right? 1 divided by 10. So 7,000 right shares. 7,000 right shares. Okay, understood? Yes. What is the offer price? Rupees, how much? At an issue price of rupees 10. Rupees 10 means at the face value only. You see, at the face value only, the right shares are offered. Okay, so the company will receive how much on these shares? On 7,000, 7,000 into 10, company will receive 70,000 money from the existing shareholders, existing or whoever it is. Okay, fine, because it can be renounced also now. Other shareholders or outside person can also come. Fine. So see here, the journal entry would be really simple. Right shares 70,000 into 1 by 10, 7,000. We just saw that. The entry is really simple. The company has received the money. How much? They have received 70,000. So bank account has been increased by 70,000. Asset increasing, you have to debit that. Bank account debit. And then capital also increased. Now we issued new equity shares. So capital increase means you have to credit, because it has credit balance. Whenever capital increases, you have to credit that to equity share capital. 70,000, 70,000. Simple and straightforward. Yeah, this is the first situation. Accounting treatment of right issue. First situation. What first situation? The situation when the offer price of right share is equal to the face value. Yeah, it's equal to the face value. There is no securities premium. If it is more than the face value, then securities premium account will come into the picture. That's all it is. In the second example, we'll just see. So see, being issued 7,000 right shares at issue price of rupees 10. That's the narration. Simple. You can write that on your own. Doesn't matter. See the second example. Second example, this is the second situation when offer price, subscription price, or the right price is more than the face value. more than the face value, not market price. It will always be less than market price, but it can be more than the face value. It will always be more than the face value. So see here, a company having 1 lakh shares of rupees 10 each, the face value, as its issued share capital, okay, having market price of 46, it's irrelevant over here, issues right shares in the ratio of 1:10. Here also the ratio is same, 1:10, at an issue price of rupees 13. Issue price means what? The offer price, subscription price, right price, okay. So it's above the face value. Face value is rupees 10, offer price is 31, okay. So 10 rupees will go to equity share capital account, and the remaining 21 rupees has to go where? Securities premium account. You all know that, isn't it? So let's calculate how many right shares first. Yeah, so see here, how many existing shares are there? 1 lakh existing shares are there. 1 lakh existing shares are there. Ratio is 1 divided by 10. 1:10, 1 divided by 10. So right shares are 10,000 over here. Right shares are 10,000 over here. Okay, so how much money the company will get? Company will get 31 rupees per share. That's the issue price of right issue. Yeah, so 10,000 into 31, into 31, that's equal to 3,10,000. So bank account has to be debited by how much? 3,10,000, because the bank account will be increased by 3,10,000. So let's the general entry, bank account debit 3,10,000, 10,000 right shares into the right price, 3,10,000, and then the capital will be increased by the face value only. Capital will be increased by the face value only. So you will credit the capital by 1 lakh, isn't it? See here, 10,000 right shares into the face value, 10,000 right shares into the face value, rupees 10, that is 1 lakh. So capital will be increased by 1 lakh, but the remaining money out of 3,10,000, remaining money has to go where? That's the extra premium money now. So that has to go to securities premium account, which is also an equity account, a reserve. So that is why it has to be credited, because it's increasing. Money is going over there to securities premium account, 2,10,000. You know, now this is a basic fresh issue entry. Yeah, being 10,000 right shares issued at an issue price of rupees 31. Here the issue price was equal to face value. Here it is more than face value. That is why securities premium will come into the picture. That's all the accounting treatment of right issue is. Okay, if the right issue is a face value, then bank account to equity share capital. If the right issue is at premium over the face value, then bank account to equity share capital to securities premium. Okay, here only face value will go, here only face value will go, and any extra will go over here in securities premium. Clear? Is that clear? Simple and straightforward. So I hope you have got this. This was an easy chapter, nothing much. Okay, so that's it for this video. See you in the next video.